From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Thursday, July 2nd, 2020. This is our first ever Jobs Day Thursday, and it's like Jobs-a-Palooza Day Thursday, because not only we get non-farm payrolls today, but we also get the usual, Thursday initial claims report today. So we're going to dive into both those. We do not have our usual NFP Day partner, Matt McDonald, with us today. He's on vacation. We do have Brendan Walsh and John Fagan from Markets Policy Partners. You're listening to the Macrocast. So, guys, we got the twin jobs reports this morning. Headline numbers: we got 4.8 million jobs created. And you know what? My notes here I put created in quotation marks. Because we say created, but in some ways, we're really talking about recreated, right? These are in most cases, we're talking about people going back to the jobs that they had before rather than brand spanking new jobs. So 4.8 million, not outside the range of, a lot of guesses. If we were making guesses, maybe not the target guess, it did beat expectations of, 3.2 million jobs. So it's a beat. We should call it a beat. We also beat on the unemployment rate. Expectations were the rate going from 13.3 last month to 12.5. It actually got down. We're down at 11.1% on the unemployment rate. Revisions: May up 190,000, April down 100,000. These are smudge marks on the table, given the large, the big numbers. And then on initial claims, despite the really positive number on job creation,
yep.
Another 1.4 million people, new filers for unemployment benefits, and these don't look like sort of stacked up numbers from dysfunctional state employment.
And actually, when you do it's actually 2.3 million if you add the federal PUA to it. So that's a lot of people still filing.
Yeah, so it's a tale of two jobs reports today.
I think you're right. Yeah.
Brendan.
And actually, so going back to Matt McDonald, when we were planning this, he replied to our email saying that he would be working from home that day. So I replied, "Are you being funny because we've all been working from home for the last 3 months, or are you telling us you're on vacation?" He said, "I'm on vacation." So that's kind of a funny story, but it also just shows how difficult it is to collect data in this kind of environment where, so the unemployment rate, actually, there's a footnote, because of how you're classified, the unemployment rate is actually about 1% higher. So we're about 12% on the unemployment rate. But, there's a lot of people that don't consider themselves unemployed. They're just waiting to get back to work. But I think, the probably the story of this report is leisure and hospitality. So about 2 million jobs came back. But within that report, it still shows the pain that restaurants are having, and this probably didn't fully capture because this comes the mid June. So really, it's been in the last couple of weeks that the South has really kind of started to pull back, especially Texas. I saw a picture of a mall in Houston, and it was completely empty yesterday. But
Brendan,
Arizona, Texas, and Florida, they've started to shut bars, right?
Yeah, definitely. On that point, and by the way, it's not just the South anymore. And
you're right. Yeah.
New York City was supposed to open for in-restaurant dining on Monday, and they now postponed that. So it will not be opening restaurants for in-restaurant dining, which is for a state that went through the worst of the pandemic, the most cases, the most deaths, then did everything right to get drive the numbers way down. It's pretty depressing for them to have to go backwards again.
Exactly, and actually, Bank of America has their own credit card data, and their latest reading saw about a 3.7% pullback in spend. And it goes back to our discussion last week, where they were showing data that people went out like one time to have have, maybe dinner, and it just wasn't a fun experience. So you're just not going to do it again.
Yeah, this is a long way of saying that. The jobs report is a backward-looking number.
Yeah, very backward. Yeah.
Obviously, good. I mean, we must see like as many jobs come back as quickly as possible.
5 million is better than 0, but we still are only we've got back about 6.5 million jobs, but we lost over 20 million. So we're still 15 million in the hole based on the BLS data. So you kind of have to keep things in perspective. What I worry about this data, I think it might be the worst case scenario where people focus on the 5 and not what the 15 and not the 12% unemployment, and also not the 2 million unemployment claims, which that still shows pain in the economy that needs a solution. They focus on the 5. President Trump's going to have a press conference in 10 minutes, and I'm sure he's going to brag about this number. So this could put less impetus on Congress to pass CARES 2.0. And John will get to what's going on in the stock market, and certainly what's going on in the stock market is not going to put politicians' feet to the fire to spend another $2 trillion.
Yeah, what are those guys doing over there, John?
Well, Brendan and I both have little kids, and so we, we see the world through the lens of children's books so often, and we liken the equity market these days as like Tigger from Winnie the Pooh. Any sort of this upbeat, bouncy, flying straight up into the air. Whenever there's a shred of good news, this, irrepressible and ebullient response to it. If COVID cases go up, the equity market, after trying to digest that for a couple of weeks, seems to be immune to it this week, with a focus potentially at whether it's on a continuing declining mortality rate, which people didn't expect. Hopefully that continues, or some of the other positive indicators that are coming along with it. The equity market characteristically bounced straight up after this number. It was already leaning positive. The S&P 500 closed yesterday only 3.5% below. Down for the year. It's almost level. It achieved level for the year just after the last non-farm payrolls number surprised to the upside. So this is a continued impetus. And then you get on the Treasury market side is the dour Eeyore of the markets, just always depressed and taking the glass half empty approach. 10-year Treasury yields, which are sensitive to the growth and inflation outlook, jumped up at the last non-farm payrolls number in May, which surprised to the upside so dramatically. We were talking about it just before the show. The expectation was for an additional 7.5 million layoffs in May after the 20.7 million lost in April. The number ended up being 3 million positive jobs added, which is just a gargantuan 10 million job swing. It's ludicrous. And the 10-year Treasury yields popped up at only, not even 10 basis points. And they closed the day after the May number at 0.088% was the 10-year yield. Today, the number.
The Chinese love that number.
Yeah.
All those eights in there. Yeah.
But going into today's number,
a very lucky, auspicious number.
It was, but it didn't last for the 10-year Treasury yield, which in the ensuing weeks slid back down into the mid 60 basis point range, and coming into today's number was 68 basis points, 20 basis points below where it closed after the May figure. That's generally consistent with the Treasury market suggesting that the growth outlook has diminished and deteriorated to some extent. And this morning, its reaction is muted, to say the least. This is a pretty encouraging number, obviously, but the 10-year Treasury yield is up just 1 basis point to 0.69%, and so this is really the dichotomy we've seen. The message from the markets has been very garbled, and it continues to be so this morning.
Jim Cramer kind of summed up the equity market. He said he woke up this morning and he looked at the screens and cruise lines were rallying, and he said cruise lines are shut. They're not going anywhere. No. But we've talked about it a lot of times before. there's nothing else to buy. So you're kind of pushed into equities.
Yeah, I think that's right. That's what Fed stimulus does to a great extent. But we've also mentioned, the fundamental case yesterday. Markets started on a pretty downbeat note, but the news about human trials progressing for Pfizer and at Oxford, that is just never fails to cheer up risk assets, and this concept that within a few months from now, we could be in a completely different space. We could all be lining up, instead of getting COVID tests, lining up to get our jab in the shoulder, which is going to end this thing.
Let's say
I make fun of the
when we get into our next segment, I want to get into a little, a little bit of forward looking and talk about what we can. So we'll do known knowns and known unknowns, but let's.
But you're right. The equity market's supposed to be forward looking. If in 6 months we can get a vaccine, you probably should be buying cruise lines, which have been battered, throughout this whole thing.
Yeah.
But I don't mean to criticize the equity market, but
I want to get into that. But let's put the jobs reports to bed. And then let's get into it. So, is there anything else in here that's interesting that you see on either report? I mean, if we're settling at somewhere in the it's still in the plus million range on initial claims, it's obviously a bad sign, right? I mean, those are just that's showing us that we've got a deeper hole that we keep digging. The jobs report itself, household survey, establishment survey, anything else in there that you guys are seeing? Participation was at the, it's obviously the not so much labor force participation, but the employment population ratio is
yeah. So I like to look at both the household data and the establishment data. So in the household data, it showed that we added 4.9 million jobs. So, I mean, I think that gives you a sense that 5 million job between the two surveys came out fairly close. So that was probably real. That's how many we created. And the civilian labor force went up by 1.7 million people, or 0.7. So it's on it's on the right path, but it's taking time. What I actually like to follow is dentist office. It's kind of a good placeholder for all of the medical.
Yeah.
One thing that's been fascinating throughout this whole process is just how important, how much healthcare is part of our economy, and the non-essential. Like, you don't have to get your teeth cleaned. You're not going to die. You can push it off. So about 190,000 jobs were added at dentist office, but that's still 10% below where we were before this whole thing started. So there's still a lot of pain and not full back to work, even in the medical profession, like dentist or going to dermatologist like that.
I know this because my sister's a dentist here in the Pittsburgh area, and she's been dealing with all of the things that you have to do to reopen.
Yeah.
She has so in terms of pent up demand, her book is full.
I would imagine, yeah.
But her book is full, but her ability to handle lots of people coming through the door is diminished because of spacing and the time required for extra, cleaning and replacing the things that you're going to be using. So it's hard to keep up with that.
What she normally was able to do, right?
How many patients can she see? Maybe a little more than half, but it's nowhere near. Maybe it's 70%, 75% of. But she's hustling to to sort of keep up with it. What she doesn't know is though is that a bubble, right? I mean, you're gonna she has to deal with this bubble of pent up demand. You can't really hire into it,
right?
Because it's going to come down and people are going to settle back into normal rates of going to the dentist, going to get haircuts,
Yeah, the people that they really needed to get it done, and they want it no matter what. But a lot of other people are just going to say, I'll just skip this one and I'll get you next year.
Why don't we take a break here, and we'll come back. We'll do known knowns, known unknowns, and see how we think about the future, what this data and other signals are telling us. You're listening to the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back on the HPS Macrocast. This is Tony Fratto with Hamilton Place Strategies, John Fagan and Brendan Walsh at Markets Policy Partners. Guys, I love to do this Rumsfeldian look because it's just a nice structure. Like there are things that we know, there are things that we don't know, and there are things that we don't know that maybe come into, and it's what makes forecasting so challenging. And so I was thinking about like what are the things that we know, right? We know that the hole is pretty deep. The very, very rapid and deep spike plunge in jobs. We know that a lot of those jobs are coming back, as we saw from the jobs report today. And so and faster than I think a lot of people thought, including me. So that's a known known. We know that we have an uneven pace on reopening. It's a big country, regions. The COVID is addressing things differently. We have this federal system where, every state and district and territory has its own rules for what to do when, and with little control from the federal government. I think we want to say that, Fed support to me is a known. The Fed is, pedaled down on everything. Now, like sometimes they have pedaled down and it stalls, like maybe what we're seeing with Main Street Lending Program, but the pedal's to the floor on it. It's just, we don't know how significant it's going to be. But with its big programs, buying credit, supporting markets, liquidity, policy rate, like the Fed is all in, and I think that's a constant for as far as we can as far as we can see.
Yeah, especially when you look at their outlook, they're staying negative. They're not getting caught up in one little good data point. I thought
it was really weird yesterday. I saw Mick Mulvaney on CNBC yesterday, back into his Freedom Caucus talking points of worry about inflation, and I'm like, man, worry about inflation, man. What a luxury it would be to worry about inflation. You couldn't worry about inflation with a roaring economy, I know.
I would love to have that problem.
Yeah. Some of the known unknowns, to me, the big ones on my list are schools, because, no matter what we've seen so far on reopening, there really is no back to work without back to school. We need, if you want people to go back to work, someone's got to, have the kids. And in America, that is the school system that generally has the kids during the working day. So schools are a huge question. Vaccines, that's a, known unknown. Everybody's working on them, both vaccines and therapeutics.
Yep.
It is a race, to get there first, to capture the flag on this. And actually, it's not even capture the flag, it's capture the flags, because it's not like when one vaccine is successful that others are going to put down their pens and stop working. They're going to continue to work on additional, more effective vaccines.
And that's a perfect example of a known because it's 100% accepted. We're going to get a vaccine. It's more the timing and how quickly we can then mass produce it.
Exactly. And then I would say, another, the last one on my list is, and I struggled actually whether I put this in the known knowns or known unknowns, but I caved and put it in the known unknowns, and that is on, fiscal, further fiscal support. Now, my gut tells me it's coming, but as I can't remember if it was John or Brendan, which of you said it earlier today about the question as to whether, a jobs report like this, right, is it going to diminish the impetus for it, or at least or maybe even just the composition of it? Yeah.
And you saw the problem the Mnuchin had in his testimony, where he has to walk that line saying, we really need more money, but the economy's doing good.
Yeah. Which is it?
Yeah, I think that's a really good point. The testimony that we saw this week with the buddy movie again, the sequel, Mnuchin and Powell on the Hill together, selling, as you said, Tony, and Brendan, a very similar story, but with different emphasis, both sounding optimistic, but expressing the need and for more stimulus as we go forward, with Chair Powell emphasizing to a greater extent the downside risks, and Secretary Mnuchin, as is his role, to be more of a cheerleader, I suppose. In the, that puts us, the fiscal stimulus, I totally agree, Tony, that is a very it's an unknown known. And what's it going to look like? We've just seen a lot of different messaging from the White House about it, and the House Democrats have put their $3+ trillion HEROES Act offer on the table. So we know the upside range. The Senate Republicans are around $1 trillion, and the White House has made noises around kind of right in the middle, $2+ trillion, with some sort of blend, maybe including infrastructure and other stuff. The composition is really foggy. We've had President Trump come out recently, I think yesterday, and say that stimulus checks for Americans will be part of it, or he wants it to be part of it. So that's the known seems to be that we're going to get some more stimulus, and the unknown is what's the composition and the time frame. And our sense, when we're talking about it, our sense is that if Senate Republicans really dig in their heels, is this some kind of sign that maybe they're hedging their bets for the election? As you said, that they're beginning to start getting their fiscal conservatism legs underneath them again, which they will obviously be wanting to assume that posture if President Biden comes into the White House, and so maybe get a little maybe get a little early start on it now. But if you're in the White House, why not max out the credit card?
Right, or frankly, any Republican, right? I mean, if you're, wherever you are, and you may be in a position where you will cut a deal with Democrats on this, because despite the despite the advice of White House outside advisor Stephen Moore, who basically said get rid of the employment bonus and don't go so big on fiscal support, which I dubbed the no bread and circuses policy. Usually the recipe of success is bread and circuses, right? Well, we got lots of circuses, and he's saying, but no bread. Both together if you really want to get reelected. And if you're sitting in the White House right now, and President Trump is down something on the order of 10 points to Joe Biden, and you're sitting in Mitch McConnell's office, and you're seeing senators in what were once relatively safe GOP held seats in very, very competitive races now. The very last thing you want are small businesses going out of business, state and local governments laying off people, people pulling back on their spending because they're concerned about where the economy is right now, and all of that happening in the fall during election season. So maybe we should put that into the knowns that politics is still politics. And you're facing this situation, you go max out the credit card, John, as you put it, and then roll into election day.
Yeah, in terms of the known unknowns on that side, Tony, we know the campaign is going to heat up, but what's the campaign going to look like? We've never seen, this was going to be a contentious and bizarre presidential campaign season under the best of circumstances, and now under these unprecedented restrictions and so forth and concerns. How is polling going to get done? Are the signals going to be completely garbled? How are you going to rally if you're President Trump? We all saw what happened in Tulsa. How is he going to get that momentum on the road? If you're Joe Biden, you've got, you maybe have the strategy is kind of stay in the basement for a little bit longer, but at some point you've got to get the ground game going. It's extremely challenging. And so I think that's a real known unknown there. And one of the other factors that we're focusing on is, the known is clearly the economy is rebounding. And as we talked about last week, a rebound is not a full recovery. And the known unknown that we're really focused on is not just the potential for relapse here, as some areas of the United States reimpose some degree of restrictions or pause their reopening campaigns, and people get more nervous after their first initial taste, the forays into outside dining and shopping and so forth. The relapse is obviously potential is a known unknown. The other is that ongoing credit stress, the potential for the attrition rate of businesses to begin to pick up in a nonlinear fashion potentially as this drags on, and as we stay below the previous levels of economic activity for longer and longer. It gets harder and harder for companies to keep four wheels out of the ditch without resorting to another round of layoffs. And certainly we've talked about this at the state level. A lot of states have said that, they aren't there yet, but they're eyeing layoffs as we discussed in that politically sensitive time in the fall.
But I think you're right, because all of this points to the one unknown that really matters, is what the shape of this recovery is going to look like. And Megan Green had the best description I've seen so far. She said it's probably going to look like a K. So everyone went straight down. Then we all bounced back up. Part of the economy is going to keep going up in a V shape. You never had to shut down. As we can reopen, you'll be able to reopen. A lot of people are going to have their jobs never come back at the low end, but also smaller businesses. Hertz can file for bankruptcy and get a loan and restructure and move on with business. The small restaurant can't. The small gyms can't. So I think we're going to see a tale of two countries in terms of how the economic rebound happens, and a huge delta in that is going to be how much the federal government's willing to support the bottom part of the K that goes back down.
There's also, look, if you were, a month ago, so if you're a month ago and you're looking at that, surprise jobs report, there were, questions about what was going on in the Sun Belt, but the numbers weren't, they weren't on the steep increase yet. And if you were an investor at that time and you're looking at the United States, you're saying, wow, New York showed how you can conquer this. They got their numbers, way down. They're, doing their planning for reopening, a month ago today. The rest of the country had either relatively low numbers or had muted their numbers decently. And, you could have made a case that, the return to something like normalcy with, hygiene and whatnot was going to be okay. But I think what you kind of wake up to when you see this, these regional spikes, is that you're never going to be fully open as long as there are regional spikes,
Right.
You can't, it's so challenging for the airlines, for example, to, have, what are you're going to deny people flights from certain parts of the country? If you are these magnet destinations like Las Vegas and Orlando, are you going to deny visitors from certain parts of the country? So people come together and mix in these places. They mix in hub airports. They mix in train stations. And it's very, very hard to contain it. So you are never fully opened if there are hotspots, but especially if if you have them in these locations. And some of the numbers truly are, frightening. We should say, yes, there's increased testing, but the numbers were off the charts yesterday, right? Over 50,000 new cases. We're in the range of 50,000 new cases a day now. And these hotspots are not little spots anymore. They are giant economies.
Yeah.
California,
and they've reached their ICU bed limit.
Yeah. California would be a member of the G7 if it was a state. If it was a country, right? These are, Texas, the same, right? These are very, very, very big economies, very important to the overall growth. And so you wonder, we've talked about this a lot. We're going to talk about it for a lot more. It's the difference between rate of growth off this bottom and levels. And the question for us is, and investors is, when do you get to when do levels recover back to pre-COVID?
I think the NHL summed up how the U.S. is doing, where they chose Edmonton and Toronto for the two cities to host the Keep it out of America.
I'm surprised that the Canadians are letting us in, but they're very nice people.
I know.
And I think
That's what I told my Canadian buddy. I said the only shot is for Canada because Canadians will sacrifice for hockey.
I think one of the other known unknowns that we have further out before the election, and the election is obviously a huge pivot point in crossroads for markets and the country and so forth. But we also have, if we do have a situation in which, like we're envisioning, this reopening continues to be messy, and that continues, and that if that does continue to keep President Trump behind in the polls and he's 10 points down, a known unknown would be he's not going to go quietly. He's going to do something exciting. He's going to have to do something big to turn things around.
Fly into the night.
There's an October
dying of the light.
There's an October surprise in here somewhere if President Trump is down 10 points and trailing in almost every swing state. Yeah. He's not just going to, cave in and say, okay, national mask mandate. That's not what he's going to do. He's going to do something else.
No question about that. Well, we will definitely have lots of time to get into that, and we have, we're going to see who Joe Biden picks as his vice presidential candidate. Yeah. There's speculation that Trump is going to replace Pence on the ballot and to generate some excitement. So we're going to have a good hot summer to get into those. But why don't we take a break here and talk about like another one of those known unknowns, or maybe it's a known known. John, you'll tell us, and Brendan, is earnings coming up. So we'll come back in the last segment and talk about earnings and look ahead to that, because we're on the cusp of it. You're listening to the HPS Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, we're back in the Macrocast, and it's not quite baseball season. It's not quite we haven't finished hockey or NBA season, but we are heading into earnings season.
Yes, we're heading into earnings season and flying about as blind as anybody can remember us on the approach here. It's first quarter saw so many companies in the S&P 500 rescind forward guidance for second quarter and the entire calendar year 2020 due to the unprecedented uncertainty. So that's 183 of the S&P 500 companies have pulled their earnings guidance, and for the second quarter, very few have of those that have retained their guidance. Very few have actually given us any sort of revision on it or any sort of additional insight. So this is going to be a real, a really uncertain second quarter earnings season. Very much everybody in the dark, and we saw a little hint of that this last couple of weeks. We saw Nike come out last week and report its fourth quarter fiscal year earnings that were just a country mile away from where estimates were. They were much worse than estimates, and the stock obviously got that shock downside sell-off on the back of it. And then this week we saw the opposite. FedEx came out and its fourth quarter fiscal results were miles ahead of where estimates had been and where analysts thought they were going to be. And the stock jumped up. This is a very mature stock. It jumped 12% in a day.
Amazing.
If these are Nike and FedEx, these are not little companies that are, poorly covered by the analyst community.
No, and they also, Nike sells shoes, which you can kind of track, and FedEx ships stuff, which you can track too. Like, I'm amazed it was so wrong.
Right. Yeah.
So second quarter earnings season is going to be a potentially really informative, very thrill a minute, and could induce some significant volatility as we go into it. Reporting starts not next week, but the week after, with again the big banks. And we saw the stress test, the Fed stress test, come out and give us some more indications that regulators are really going to keep on the banks to retain capital in a way that they haven't before. And there's going to be a huge focus on their credit provisioning. Just how much deterioration have they seen in the credit books?
Yeah, so to me, I'm really looking forward to earnings season too, because I think it's going to answer just a lot of questions, because they are the most, that's the most tangible things that we can have. I mean, even, jobless claims, initial claims are real and tangible and immediate. They're good signals. The payroll data is backward looking, and it's modeled, and and it's really hard to model in this environment. There isn't really modeling going on with earnings, right? It's old-fashioned mathematics, and so I'll be as interested in not just the numbers, but the sort of verbatims from the transcripts when we get to that, and just listening to CEOs and chief financial officers talk about the state of their business right now and what they're seeing. I think it's going to be really, really fascinating. Yeah. All right, guys. Hey, it's did I say it's Independence Day this weekend? It's 4th of July. It's a reason we're on a Thursday. I think I failed to recognize our Independence Day. But I want to wish you guys and our team who's helps produce the show, and all our listeners out there have a wonderful 4th of July holiday. If you get the long weekend, have a joyful long weekend. We'll be back with you next week on our usual day on Friday. Take care.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.